What is synthetic identity fraud? Have you ever wondered how someone can create a fake identity that seems real enough to fool banks and credit unions? This is known as synthetic identity fraud. It is a type of financial crime where a fraudster combines real and made-up personal information to create a new identity. This often starts with a legitimate social security number taken from someone who may not closely monitor their credit, like a child or an elderly person. The fraudster then pairs this social security number with invented details such as a false name, date of birth, address, phone number, and email. The result is a composite identity that does not belong to any real person but looks authentic enough to open bank accounts and access credit. Synthetic identity fraud is particularly challenging for banks and credit unions. Traditional fraud detection systems struggle to spot these fake identities. Unlike typical identity theft, where a fraudster uses a complete identity of a real person, synthetic identities are partially fabricated. Over time, these identities can build a positive credit history, making them appear legitimate. Fraudsters often nurture these synthetic identities by gradually applying for credit and making payments. This helps them establish credibility before exploiting the accounts for financial gain. There are several methods used to create synthetic identities. One method is identity compilation, where a real social security number is combined with made-up personal details. Another is identity manipulation, which involves slightly altering real personal information, like changing a name while keeping the same social security number. The third method is identity fabrication, where entirely fake identities are created. However, this is less common because it is harder to pass verification checks. For financial institutions, synthetic identity fraud leads to significant losses and operational risks. These synthetic identities can pass initial verification checks, allowing fraudsters to open accounts, obtain loans, or make purchases that are never paid back. To combat this type of fraud, banks and credit unions need to use advanced verification techniques. This includes using analytics, cross-referencing multiple data sources, and monitoring for unusual account behaviors over time. When it comes to fraud reporting procedures, financial institutions must have strong systems in place to identify suspicious activity that may indicate synthetic identity fraud. Prompt reporting and sharing of fraud patterns with industry partners can help reduce the impact. Educating customers about monitoring their credit reports is also essential. Encouraging vigilance, especially among vulnerable populations, supports prevention efforts. In summary, synthetic identity fraud is a sophisticated financial crime that blends real and fake data to create new fraudulent identities. It challenges banks and credit unions to improve their fraud detection and prevention strategies to protect both their institutions and their customers from financial harm.